to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and today we have the privilege of welcoming back to the show Chris Bates, who you may remember as a mortgage broker par excellence. He's also a co-host of the Elephant in the Room property podcast, which is one of the best ones out there. And so I sit down with Chris today to discuss the situation we're in at the moment with the lending environment, how he has seen inquiry change with the interest rate cuts. Of course, I speak to him about what he thinks will happen in the end of the year and his prediction for where we are with rates. I ask him the question, what does this rate environment mean for your borrowing capacity? We also talk about APRA and its serviceability buffer, whether that might change and what impact that would have. And we finish with a question about what he believes property investors need to know to grow a large portfolio in 2025 and beyond. Outside of that, we talk about a couple of different markets. We talk about Melbourne, we talk about Darwin, we talk about hotspotting, and Chris is awesome with his answers to all of those questions. You're going to get a lot out of this one for sure. Here's Chris. Chris Bates, thanks for joining me back on Geared for Growth.
Awesome to be here, Mike. Looking forward to this.
It's been a little while between drinks, but I figured who better to catch us up to speed on the state of lending at the moment, because we're in a different part of the cycle. We talked for years about the unprecedented growth in interest rates. We had that little cut and there was a bit of conjecture about what was going to happen next, but quite a big market response from that first 25 basis point cut. I want to start with that with you. What was inquiry like the moment that was announced?
Look, it's a bit of a hard one to measure, to be honest. I do think that going back all the way through to the first rate increase, that when that happened, I think people were a little bit shocked. They were like, okay, we expected these to happen, but once it did happen, they were like, oh, actually rates are going up. And then they were shocked how fast they were going up, and it caught everyone by surprise. And I think over the last, in 2024, a lot of people thought rate cuts were going to happen and they didn't. And so they really wanted just to make sure that they were actually coming. And I think the first rate cut, I think everyone was like, yeah, this is good. They're finally coming down. But I reckon it was the second one where we saw inquiry probably started to really pick up, because I think it's not just the expectation that two rate cuts have happened, but further ones are coming. And, and real expectations over the next, say 6 months, another 3 are coming. And so I would say it's the second cut that we probably saw a real spike in inquiry, not so much the first one. But I think a lot of buyers really wanted to see it happen before they took action, because they really jumped at shadows back in 2024.
Yeah, that's interesting. I did hear from a few buyers agents that there were people that just must have been sitting on their hands waiting for something to happen. Perhaps it wasn't that cut itself, but it was more an indication that the raising cycle had finished, because there were a couple of months where it's like we could actually see an interest rate rise because of the sticky inflation, but that maybe was kind of the nail in the coffin of this rhetoric about rises. So it's interesting to contrast the second one. I suppose, any good data analyst would say one data point doesn't make a trend, but now we do have a trend and the trend is down. So you're seeing a lot of people come out of the woodwork now?
Yeah, I think it was like September, August time back in 2024. There was a real, the whole inflation story flipped, yields really dropped. It was maybe going to be a rate cut in late 2024. We absolutely saw a big spike in inquiry then. And, I think then the rate cuts that didn't happen. And people were like, oh, hang on a sec, I really want to. And then it came into 2025, even though there was expectation that rate cuts were coming, it wasn't until the second cut. I think there's, yes, buyers are there. Yes, they're keen to transact. But I don't feel like there's FOMO in the market, because when they look at it, they're still going to be paying, 5.5% interest rates on the debt, which isn't cheap, right? Like it's not, and particularly if you're looking to do an upgrade, right, and you're going from an apartment to a house, or a small house to a bigger house, these jumps are quite large to make. And so I think a lot of upgrades are still sitting on their hands, and it's a bit of a Mexican standoff for them, because they're out in the market going, well, yeah, I'd like to, but I can't even find anything I want anyway. And, the stock levels or listings in, the first half of the year are still pretty tight, because, people aren't considering doing those upgrades until the rate cuts happened. I think psychologically, though, I think if there's 2 more rate cuts and we start to see bank rates under 5%, maybe that's a time when people go, oh, if I don't upgrade now, I'm going to regret it, and rates are getting more and more affordable. And I think that's where psychologically that'll bring in a lot more buyers in.
And I suppose from an investor side of things, that's where we start to get to the point where properties are looking a little bit more neutrally geared rather than right now at the moment. It is really difficult to find a yield unless you're going to regional Northern Territory to pay off the loan, right?
Yeah, I think that's absolutely the case. I do think there's been a bit of an investor boom. I think there's been more investors bailing than buying, I feel, though. I think that's why we've also got a rental crisis and very low vacancy rates. And also the new investors haven't been buying where the old investors used to own. I mean, typically it was capital cities, and all the new investors have been going into regional hotspots, and the proliferation of quantity sort of cheap and cheerful buyers agents, I would say, have been driving that. And I think... but as interest rates do come down and people get more and more comfortable with their home loan, they're going to say, hang on a sec, maybe I should actually buy an investment property and I can afford the negative cash flow because rates are falling and they're likely to go down further. And there's still a rental crisis and vacancy rates are really tight. So maybe there's still, increases to rents coming. They have been slowing down. So I do think those, and rents have gone up a lot over the last few years. So if prices haven't run, then yields are higher and investors' cash flows are looking better because yields are higher.
Well, if we look back to, let's say, 2024 calendar year, we saw 3 markets really galloping along. That was Perth, Brisbane and Adelaide. And, the whole median table of the capital cities got thrown around and Melbourne sort of found itself tumbling down. But I do feel like there is this kind of idea about finding the next Perth, for example. 23, 24, we saw some huge gains in markets. I think calendar year 2024, we saw 19% growth in Perth, and I think its annualised rate, got up to about 24% over a 12-month period, which is absolutely bananas. But everyone kind of seems to be drunk on that success. The people that got in at the right time or the people that missed out are now looking to, well, where can I actually find the next one? And it does sort of seem like there's 2 places that eyeballs are going. One of them is Victoria, and I suppose there's a big mean reversion kind of bias there. The other one is Darwin, and I want to sort of unpack the 2 of those with you and contrast the 2, because you're someone who's an advocate of blue chip. You're not necessarily anti-region, but I'm guessing places like Darwin make you a little bit nervous.
Look, I do think that you've got to understand who are the investors buying into these locations. Are they buying for long-term buy and hold, or are they, for example, first home buyers that are buying investment properties because they're rent vesting, or are they people who are literally trying to turn over? A lot of the strategies for these investors is they know that they're not going to be long-term holds. They're trying to capture the growth and they're going to bail. And so if you're playing in those markets, you've really got to, A, get the market right, and B, you've got to be early. So if you're trying to buy in Darwin now, maybe even 6 months later than you probably should have been. Probably the smart money was there 6 months ago. And you've got to bail before everyone else bails, because you can very easily get your situation where you don't get the top of the market. It gets a bit frothy and the market corrects, and then all of a sudden a lot of other investors are bailing, and then you get oversupply, and then so prices come back, etc. So, and then your gains might not be as big as you thought. And so I think this, like you said, everyone's trying to find the Perth, the Adelaide, the Darwin, Toowoomba, etc. But it's really not a buy and hold strategy. It's a buy, get in. It's kind of speculating. I don't think it's long-term investing. And when you're doing that type of investing, you've just got to be really careful, because if you don't capture it, you don't buy well, you don't sell well, that you may not get the gains. And the problem is you're still burning years of other investing that you could have done. For example, you could have just went and bought a house in Brisbane that you might want to hold for 20, 30 years. You've got to pay capital gains tax. And I would just say I personally am not a huge fan of that strategy. It's done really well over the last few years because affordability has been really tight, and a lot of investors budgets have been pushed down. But I'm not sure whether I'd want to be holding majority of my asset in those type of properties.
Last calendar year, we saw the average amount that property investors were spending on an investment property in our own data at $650K. And if you remove some of the outliers, for example, we had an $11 million unit in that sample size. You remove some of the outliers, it gets closer to 550. It kind of begs the question, well, where are we going in Australia for that sort of price point? And I want to kind of put the question to you. Just because we could find something at that price, should we buy it? Or do you actually think it's better to perhaps save a little bit more or wait a little bit longer to try and find something that's going to have, a little bit less risk baked into it?
I think from an investor's point of view, I'd also really challenge them to think about their home first. Is this really where they're going to live long term? Is there benefits in terms of upgrading? And, increasing your debt on your home and getting a bigger or better tax-free asset versus, a cheaper home and an investment property. Sometimes people forget about that strategy. If you are going to go down the investment route, sometimes people feel more comfortable if they diversify and they have multiple properties versus one property. But you have to really also understand is that the diversification benefit comes with certain risks, right? You've got maintenance on 2 or 3 properties. You might be playing in areas where there's issues with supply or high density apartments, or regional locations where maybe demand's not as strong, a multifaceted economy, etc. And it might not be as consistent growth over the longer term. And so personally, I would say that, if you have got a tighter budget, and also it depends if you're an investor, whether you're an investor who's got lots of equity, or you're an investor who's only got a little bit of equity and is trying to leverage the money. Now, if you're an investor with lots of equity, who's to say maybe in property is not the right move? Maybe you should be going into shares or maybe looking at commercial property, etc. And I think you've got to be just a little bit, depending on what stage of life you're at as well, whether you're getting closer to retirement or you're younger as well. And so a lot of people just sort of say, well, I want to buy an investment property, and they rush it and they go, okay, I don't want to spend more than 500 because I'm comfortable at that level, and they sort of ignore all the other options.
Yeah, that's a very, very good point. I want to change gears for a second and talk about the federal election that we just had. Obviously, it was a massacre for the Liberal Party, and then they recently disbanded from the Nationals, and now they're back together as a coalition. It kind of seems like the weakest the Liberal Party has been in recent memory, which opens the door to Labor legislating with a lot less resistance. And one of the things that they've thrown out there that's getting a lot of commentary is the tax on unrealised capital gains in the super. Is that something that you're having conversations with your clients at the moment?
Look, it really affects more the 60-plus range, and we don't really have too many clients in that range, but it would be their parents, and a lot of advisors would have clients that have got self-managed super funds and bigger super balances. It's a pretty horrendous tax in terms of taxing unrealised gains versus realised gains. However, I can see exactly why they're targeting superannuation. I mean, there's a lot of reports on WiseTech, investors having huge amounts in superannuation that are paying very small amounts of capital gains tax, etc. So I can see why they're doing, and I can see why they're attacking superannuation due to the large balances in there. I think ultimately, though, if you did have a large balance in super, you'd be thinking, do I really want to keep it in this structure? They're really, making the incentives or cutting back on the incentives and making it much harder to manage this. Do I take that money out? Do I invest it in other structures, whether it's trust? Do I upgrade my home? Do I give it to my kids? Do I give it to my grandkids, etc.? And so I do think it's going to change where people invest and in what structures they do. But I do think that's going to push more money into residential property. I think that'll be either people will put it into their own home, or they'll pay off their mortgages and then they'll buy other investment properties, or they'll give it to their kids and then they'll leverage it. So I think that's the real consequence of that policy, is that if you force people to take money out of super, what do they do with that money?
Yeah, that's a very, very good point, and it always just kind of makes me think of the Newton's third law of motion. There's an equal and opposite reaction to some of these tax impulse. So it'll be interesting to see the way people duck and move to work with that. Now let's get your crystal ball out, Chris. I know all of my guests, whether they're buyers agents or finance specialists like yourself, love this one. What's your expectation for the direction of interest rates in the next little while? And for people that are very conscious about, our strategy is so tied to this, what advice would you have for those people? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Look, I don't really try to have an opinion on it and sort of try to be smarter than money markets, but I'll just sort of track what they're expecting. I mean, they're expecting sort of an RBA rate circa 3% by the end of the year, right? So maybe three more cuts. And if we get that, we might get bank rates closer to sort of 4.7 or maybe even 4.5%, depending. And if they have to, maybe the economy isn't going to go as well as they think, and maybe it goes a lot lower than that. And if it does, every time, if that goes maybe under 3%, you've got to think that that's going to encourage a lot more people to want to enter the market, and you'll see a lot of FOMO kick in. It'll be similar to sort of a 2020, 2021 sort of scenario, I reckon. And so, I think as someone who's maybe thinking about buying their first home or upgrading, that's going to be a huge tailwind behind prices. The second thing is that the government 5% deposit schemes, while they've been around for a few years now, they have had some significant sort of caps in terms of income that you need to qualify for those, and also city limits. From January, those sort of things really don't exist. There are still city limits, but they're at a level where a lot of first home buyers probably weren't going to buy anyway. And I think that's going to encourage a lot of first home buyers into the market. Plus, a lot of investors, I feel, will want to look at property just because naturally it's been seen as a safe haven. And secondly, people are saying, well, superannuation isn't going to be able to deliver, isn't sort of my one-trick pony for retirement anymore. I can't be assured that I'm going to be able to put in lots of money in my 50s and have a huge amount in super, because they're already showing that in today's terms, they're really trying to limit that. So what are they going to be doing in 20, 30, 40 years' time? And so people are going to have to say, well, I'm going to have to build assets outside of super, and property makes a lot of sense. So I think you're going to see a continued investment boom, and we've already been having that for the last few years. See a lot of first home buyers in the market, and as rates come down and borrowing capacity goes up, there's a lot of pent-up demand in property markets. People in apartments that want to be into houses, people in small houses who want bigger houses, and there's also a lot of people that are stuck in properties that just can't transact. And so you're going to see continued low supply. The turnover rate of properties just been going in lower and lower every year because people would love a bigger house or move to a different suburb, but they can't afford it. And I do think you're going to see continued demand as rates start to fall, not just from first-home buyers and investors, but upgraders entering the market again.
And that kind of segues nicely into the question that I wanted to put to you about the APRA serviceability buffer. So that really came in at a time where interest rates were low, investor activity was very, very high. We had, caps on interest-only components of banks' loans, and the 3% serviceability buffer was there, almost like a recognition that prices, well, let's say interest rates were going to increase. We're now actually on the other side of the spectrum, and the trajectory only really seems to be down, yet we've still got this 3% buffer. A few people have sort of commented that this is something that APRA could look at. But if we do get another couple of cuts, that's going to stimulate the property market. So any decrease in that serviceability buffer is going to really put that on steroids, I would have thought. What's your view on that? Should we get a change, and what would that impact be?
There's always pressure to let the banks lend more money. The coalition pre-election sort of said that they would put a bit of pressure on APRA to cut that buffer. Because the banks are saying, well, it's kind of a haves and have-not society. When lending multiples of income are really tight, you either have to have a high income or you have to have intergenerational wealth. And I think what we've had over the last couple of years has been a bit enlightening for me, because it's sort of a lot of the first money really coming down the generations, giving while living, sort of more the philosophy families are taking versus passing on death. A lot of 60-year-olds maybe got it from their parents when they died in their 80s and 90s and said, it's great you've given me this money now, but I could have really benefited having this money 20 years ago. And so I think money coming down generations, we've seen it, because a lot of families have needed that. They've wanted to buy at X price, say $1 million, but they can only borrow $700,000, and all of a sudden money's come down from family. And so if you haven't got access to intergenerational wealth and you can only borrow 5 times your income, it's really hard for first home buyers to really enter the market. And so what banks are basically saying is that it gives people an unfair advantage for people who are on higher incomes and people who've got intergenerational wealth. And all lending data sort of supports that. The portion of buyers that are on medium and higher incomes is far outweighing their actual percentage of the market. And so they're having a much bigger dominant force. And so banks are, CEOs are all going to be in APRA's ear and saying, hey, this isn't really fair. You really need to lower the serviceability buffer. I can really see them doing it for first-home buyers. We've already seen changes around HEX and HEX not maybe being included for some first-home buyers and increasing their borrowing capacity. Maybe APRA step in and say, well, for first-home buyers who've usually got a higher trajectory of income than, say, the 40 and 50-year-olds, maybe they can do it on a lower buffer. And maybe they get a bit more of an advantage versus, say, investors and upgraders. But I haven't seen that. I don't think that's happened in the past, but I think that makes more sense than giving everyone in the market, maybe, because if the APRA cuts their serviceability buffer from 3% to 2%, that 1% would increase borrowing capacities by 10%, and that would very quickly get factored into prices. It would just give the market, everyone who's buying now, more borrowing capacity, and people would naturally spend it. It'd be a very similar situation to 2019 post that election.
And I think it's probably a situation that the RBA wants to avoid, but it does raise a really interesting point. You've got the intergenerational wealth, you've got the first home buyers that are really sort of strongly governmentally supported, but there is kind of like a missing middle, and it does kind of seem like there is a case for almost like a humanitarian issue of the people that are missed out in that middle point. But we do seem to really just focus on the first home buyers quite disproportionately. But I want to ask you about the way in which we're doing that. When we have some of these grants, it just does seem like it's great if you're one of the 40,000 or 100,000 people who qualify for it, but it does make it a little bit more expensive for everyone else that missed out, or they're going to be a first home buyer next year. Do you feel at any point that we are just kind of kicking that housing affordability can down the street with the stimulus at the bottom end?
Oh, absolutely. I think the people who are going to benefit the most are current owners. And people basically taking advantage of those schemes, very early on. And, I think that's... So if you're a first-home buyer and you might think this is a great policy, I can only borrow with a 5% deposit, but you're 2 years away from buying, well, I don't think it's really going to help you. And so anything that really helps first-home buyers very quickly gets factored into prices. But unfortunately, they win votes and they change election outcomes. And, and ultimately, I think there's a lot of other things they need to be doing. But I do think this is like the evolution of the market. It's kind of like a Ponzi scheme, right? You need more first home buyers to come, whether it's immigration or allowing more first home buyers to buy. And unfortunately, that's just the system that we've built.
You raise a really interesting point about immigration. I mean, we saw the December quarter, I think back in 2023, a reduction in immigration because it was in the news. It was a big media article about, or a big media topic about we need to limit immigration because it's putting pressure on resources, putting pressure on rents and housing. But it did sort of seem to get back to galloping, and the pace of construction is about 30% lower than the target set of that 1.2 million homes. I think for anyone that's kind of wondering why we have so much immigration, I mean, we had an unemployment rate in the 3% sort of range, and lots of people like restaurant owners were saying, well, we can't get people to wait tables. There seemed to be a real shortage of workers, but now we are actually sort of having to pay for that increase in immigration. And as you say, rents have grown so much. I think there's been some disincentives for investors in certain states like Victoria, for example, that have exacerbated the problem. But it does sort of seem like we are in this little bit of a mess. We're not building fast enough, but we rely on immigration because outside of that, we would have been in a per capita recession. How do we solve this, Chris? This is a very grandiose question to put to you. And maybe it's a crystal ball one as well.
Look, I do think that the structure of the way that we build our cities is going to have to change. I think if you look at New South Wales and Chris Minns, I think it's pretty brave what he's been doing, and has really pushed back on the NIMBYism that's been systemic in the Sydney property market, and has basically said, no, we're going to override that. And basically even today, there's more articles coming out of how cities and suburbs are going to change in the city, and I think this is really the future of Sydney, Melbourne, Brisbane, and planning controls. It's going to be pro-development. I think that's how we're going to, grow our cities. It might feel like we've got a lot of immigration and our cities are full, but I think that's just because they're being built inefficiently. And, we've got a lot of single-dwelling houses, 3, 4, 5 k's from the city, and I think that's going to change a lot. And, we're not like these cities are the biggest cities in the world. A lot of other cities have got bigger populations than we have. I just think that we need to operate on a much better way, and I do think that the Australian society gets a lot of benefits from immigration, and a lot of people who are living here today have benefited from it. And so shutting our doors isn't just so simple from an economic point of view.
Yeah, you raise a really good point about density, and obviously New South Wales has been leading the charge with the zoning changes in and around the transport hubs. But we ran a research project, I think it was back in February, where the topic of that really was NIMBYism, and looking at suburbs that have seen less than a 1% growth since the 2021 census. And there was one particular council in Victoria that averaged 16 objections per planning assessment or per development approval. So it's clearly that there is a NIMBYism that finds its way into the markets. Now, you mentioned what the serviceability APRA change would be. So if we've got 1% serviceability buffer compared to, a 1% drop in that serviceability buffer, it's a 10% increase in borrowing capacity. I wanted to know what is likely to happen if we do get those, let's say, 3 extra cuts. What does your borrowing capacity look like at the end of, say, this year compared to before those rate cuts started happening?
So you might say it's about a 5% increase already, just because there's been 2 cuts. So if there's another 2 or 3 or 4, maybe there's another 5 or 10%. But if APRA jumped in and gave another 10%, I think there's bank innovation that's going to continue to happen. I think we're going to start to see 35, 40-year loans. Like you said, we've already seen innovation around HECS. There's been sort of tweaks to how they assess rental income or bonuses or self-employed. So banks are always going to, particularly in this tight lending environment, is try to find tweaks to their policies that, non-banks can do at lower serviceability buffers, etc. So I think, without factoring those things, just rate cuts alone, every 1% of rate cuts maybe adds 10%. So if we've already had half a percent, then that's 5% drop in increase in borrowing capacity. So I don't know, let's say it's 15, 20% potentially by next year. That when buyers are spending every single dollar, and most buyers are, because it's not the same times when people went to banks and said, oh, how much can I borrow? And you could borrow $1 million. Well, I only want to borrow 500. It's way too much. When I started back in broking, the amount you could borrow based on versus what you wanted to borrow was way more. But, often nowadays it's, we want to borrow more. Any banks lend us any more money. There's shopping the market. Borrowing capacities are really, are really tight, and people are spending every dollar they can get.
It does kind of seem that there must be some sort of innovation when the multiples of salary to asset price continue to grow, right? And I can remember going back and seeing advertisements where I think the standard mortgage was 7 years and it got increased to 9. I'm sure there's resistance when people say, look, we might need to talk about 30 or 40-year mortgages, but it does kind of seem like the availability of credit is really, really important to all Australians, and there's a million different reasons why you need credit. Is that the only way to go? Because there's nothing that sort of speaks to me that says that asset prices are going to drop by 20%.
I think that we are going to... and I think people's attitudes to debt have changed, right? So maybe your parents or your parents' parents debt was bad. You need to pay it off as fast as you can. And there was always a fear of, the higher interest rates of the 90s, maybe scared a lot of families that they really wanted to have no home debt. I don't know whether Gen X, Gen Z, the next generation have got that same fear around debt. And maybe they're more comfortable to take on debt through their whole working life, all the way up till retirement, and knowing that they're going to sell that property in retirement. And so I think that people are getting more and more comfortable with it. I do think that we'll see longer loans. I do think we'll see interest only make a comeback. And I think that, people are just going to naturally not be so focused on paying down their debt. It's the consequences of having to buy. People are just going to have to hold debt through their whole working life.
That's a good observation. I want to ask you about, there's a cohort of listeners to this show and many other podcasts that are dreaming big, and they're looking at influencers in the space, in the property investment and finance space, that are growing these massive portfolios. I'm wondering, your advice for someone that's wanting to, say, become a multi-portfolio investor. They've set themselves a goal to get 6 properties or 10 properties. There's a lot of content in and around, all you've got to do is use non-bank lenders, and then you've just got to fire up a trust every 5 minutes, and that's the secret to getting unlimited capacity, and everything goes up eventually, so you'll be fine. I want to get your thoughts on the state of that kind of part of property and the way that this is sort of put out there as a panacea to help you to get to where you need to be. What do people need to understand about the lending environment if they are trying to grow a big portfolio?
Look, it's not 2013 anymore, and you can't borrow 12, 14 times income. You can't play banks. You can't just get unlimited lending. Even if you want to use things like trust, you need bigger deposits, and a lot of investors just don't have that cash. Commercial property can work, if you've got big deposits and keep on borrowing, but often if you want to go down the resi route, you'll just naturally run out of borrowing capacity pretty quick nowadays, because you can only borrow sort of 5 times your income. And a lot of these sort of big property buyers agents that are peddling, they've got these huge portfolios. They've done it under different conditions, and often what's driving them to be able to buy bigger and bigger portfolios is the success of their buyer's agency business, that's giving them higher incomes, which is allowing them to leverage their money and buy more property. So it's not the success of their strategy, it's the success of their buyer's agents that are allowing them to build these portfolios. And they do peddle, I've got these huge portfolios, but the thing that's driving them is their buyer's agency. So just be really careful around that, because I don't think that's really fair. I don't think it's relevant that they've got a huge portfolio because they're earning a lot of money, rather than because their strategy's been so successful. And so don't fall for that one. That would be my first thing. It's actually really hard, to go and build a big portfolio of properties and consistently buy, and just be really careful. All the sort of, I can make short-term money growth, and we're going to buy this and get a better val and things like that. That's, to me, the only real money in your pocket when you sell one day, and be really careful for the buyer's agents promising short-term growth.
I think that's a very good and sensible way to finish. Chris, thanks for sharing all of your wisdom today. Much appreciated.
Thank you, Mike. Talk soon.
Cheers.